We're going to get him on the Zoom call here. We're going to show my screen here. How we doing, brother? Are you with us?
Yeah, man. How are you?
I'm good. You can hear me okay?
Oh, yeah.
Okay, sweet. Thanks for coming on, brother. Okay, so I'm just going to do a quick intro, George, and then I want to the first thing I want to ask, just so you can start prepping for this, is just what your take is on the fact where the stock market is now, and where the real economy is right now, and that disconnect. I think a lot of people are spinning on that and are wondering how the fook that's possible. So I'd love to hear your take on that. But before that, George Pearkes is a global macro strategist. He's been featured in Financial Times, Barron's, Bloomberg, and CNBC, and now recently No Gradient, which is epic. More importantly, he was a walk-on to the Duke football team, which is epic. And I'm actually in Durham, North Carolina, Brother Beast, right now, so I don't know where you are, but right on, respect. Okay, George, thanks for coming on. And so the first question, how do you think about where the stock market is and where the quote unquote real economy is right now?
Oh, well, just first, I'm just right down the road, 2 hours southwest you in Charlotte. So
nice.
We're almost practically next door neighbors by the standards of
right on.
The way the world works these days. So I think the first thing was where stocks are. It's important to understand that stocks are forward looking as opposed to backwards looking.
Right.
So I don't subscribe to this view necessarily in terms of, stocks are fairly priced, but you could definitely make the argument that if the global economy turns around and activity starts to rip as people exit lockdowns from the coronavirus, and as things start to recover, then, the stock market is applying that forward pending activity to its discounted present value of the future. I am much less optimistic than that in terms of where activity is going to go. I think, we will see a bounce in activity versus what we saw in March and April, but the amount of bounce back and the degree to which we return to trend is going to be much less than people have priced into the market and much less than people expect in general. I think a return to the same trend we were on pre-crisis is unlikely. And the primary reason to think about that is what happened after the global financial crisis. So the trend growth of 3-4% per year in real terms for the US yielded down to something like 2% after the crisis. So basically, we had a shock to both the level of GDP in terms of a recession, and then the recovery was weak in terms of not catching back up to previous trend, and we're still nowhere close to that today. And I think the same thing's going to happen as we emerge from the COVID crisis as well. Now, the pushback to my view would be, well, people are going to start, there's a lot of pent up consumer demand, and there's a lot of desire for companies to get back to normal. And also we've had massive amounts of fiscal and monetary stimulus that's just going to send stuff ripping in terms of consumer spending and investment. And so that's the opposite view to mine, basically. But in both cases, it's important to always acknowledge with the stock market that's forward looking. So, what you're talking about is the difference in forecast for where things go as opposed to the difference in, right now versus where things will be in 3 months.
Right. Yeah. I'm glad you touched on that, because I think a lot of people like to dunk on. A lot of people are dunking on the stock market and saying, "Look, it doesn't mean anything. It's not tied to your everyday American." Well, it's discount. It's about what the future outlook is, not what it is right now. So I'm glad you touched on that, because I think a lot of people don't realize that. Okay, you touched on this in your last point about the actions from the Fed and Warren Buffett. I just watched some of his statements on his shareholder meeting, and he basically said Jerome Powell did. He thinks he did the right thing. He thinks what the Fed. He said something to the effect of, we don't know the consequences of what the Fed's doing right now, but we know the consequences of doing nothing, and that would have been much more disastrous. So I'm curious what you think about what the Fed is doing with they're buying junk bonds and pumping so much, getting so much value on their own books. Where is your head at with all that?
Okay, so I think the first thing to say is like always, the Fed avoiding a liquidationist moment in the U.S. economy is always the right policy. There is no defense of that particular outcome, and the reason for that is that liquidationist moment is one that destroys the most capital, destroys the most productive capacity.
For those of us that don't know, because I don't even know 100% of can you talk about, just expand on the liquidation? Like, what do you exactly mean by that?
So basically, unwinding all of the economic relationships that have created value because the funding doesn't exist to maintain them. Um,
Got it.
so this is in part a function of having a leveraged society. It's in part a function of having just a modern post-industrial and complicated value chain society. But there's this series of interconnected economic relationships that work out in effect to leverage counterparty risk. Valuation on assets. Some of some of this is reflected in aggregate market cap of the stock market. Some of it's reflected in the complexity of modern supply chains. Some of it's reflected in the specialization of the labor force. These are all sort of parts of the same system in the sense that there's a lot of complicated relationships that are knitted together. And what the Fed said basically is that we're not going to let all of those fall apart.
Right.
Some of them are going to fall apart no matter what we do. Some of them are going to fall apart even though we're going to intervene. But for the vast majority of these relationships, we're going to make sure that there isn't a panic moment across the whole economy, across all companies, across all modes of production, to where everyone's liquidating into nothing. And they did that in a couple different ways. So a couple of their backstop programs in terms of the commercial paper market and the money markets and primary dealer financing, those were all designed to prevent that sort of liquidationist environment. The other big thing they did is just plain standard familiar quantitative easing, purchases of treasuries and mortgage-backed securities. None of the programs that they've introduced in terms of the alphabet soup of credit-related programs, some of which will involve buying small amounts of junk bonds in the secondary market. Others are much, much differently wired than that particular thing, which I think a lot of people grab to. I think a lot of people sort of misunderstand that the Fed is suddenly going to go out and buy all the outstanding issuance of HYG or something like that, and that's not what they're going to do.
Right.
But those credit easing programs in terms of facilitating the flow of credit to the real economy are still not started up yet. Nothing the Fed has done so far in terms of actual actions has involved purchasing corporate debt or lending to a corporation or lending to a municipality. They will, but it's still starting to, with the exception of the commercial paper markets, which is sort of a different thing. So anyhow, I guess, as you said, like what Buffett said is, he basically said there were people sniffing around for deals, coming to Buffett for that super high cost of keep me alive financing that he offered to a number of banks during the financial crisis and that he's offered to a number of companies over the years. And
Right.
he basically said, look, like a couple people were sniffing around that, but they didn't actually come. And the reason is that the Fed stepped in. Powell himself in the most recent FOMC policy decision press conference said, look, we want the private markets to do the lending. The fact that Boeing is able to go out and issue $25 billion worth of
Right.
barely investment grade paper is what the Fed wants to happen without ever having bought a corporate bond. They never had to do that.
Right.
So that's the dynamic I think that the Fed is trying to pursue, and that is the right call, because the opposite of that is no recovery from the sort of mass unemployment that we saw in March and April. No recovery from the sorts of output declines, consumer spending declines that we saw in March and April for long periods of time. It's what we saw in the Great Depression, right? The Fed their one job really is to prevent another Great Depression, and they're really getting good at it. And frankly, I think the criticisms around hypothetical and imagined costs associated with that in some circles really get pushed just way too far to the fore, to my taste. And I don't necessarily think that the outlook for the economy is good, and I think the market is overvalued right now, and yada yada yada. But the Fed still did the right thing.
Wow,
For sure.
I love that. I think you put me at ease a bit. Howard Marks had a memo. I forgot which day he put this out, but I remember reading it. I was like, is capitalism dead? Because all the things he was saying about what the Fed was doing, he wasn't saying they were bad. He was just asking all these questions like, we don't know the consequences of this, but the way he was asking the questions, it was very like, oh no, is dynamism gone? Is this the Fed is now the official lender? Blah blah blah. So it was just it was a little scary.
Whenever I hear a guy like Howard Marks put out an investment memo, all I can think is keep bono, right? Like this is a guy whose entire premise in the markets is buy distressed assets. Buy assets when nobody else will buy them, when they're the most possible dislocated from their value. That's a liquidationist event, right? And I mean, Howard Marks is a very smart guy. I'm not trying to say that everything he's doing is self-serving and everything he puts out is self-serving, but I think you really need to be taking those sorts of analyses from those sorts of investors with at least a grain of salt,
right?
Which I mean isn't to say that he's dead wrong or that he necessarily is somehow misleading people, but I mean, just be skeptical, right? This guy's whole raison d'etre is to go out and buy stuff that's gotten just liquidated.
Right, because he works in the credit. He's a credit. He does credit stuff.
Yeah, Oaktree basically they're a distressed credit vehicle.
Right. Okay.
They want to be buying the debt of companies that are going bankrupt. They want to be, providing financing to people who can't get it anywhere else, and that's a totally legitimate investment strategy. I'm not criticizing that investment strategy at all. I'm just saying the world he wants is the one that the Fed desperately wants to avoid going into.
Right.
And so, it's no wonder he's opposed to it. I mean, I would be too if I was.
Well, so I wouldn't say he was. Yeah, I wouldn't so much say he was totally opposed to it, but it was interesting just the way he was asking the questions were, because his whole thing at the end of every time you read his memo, it seems to be like, I don't know, and that he was just like, I'm looking at this stuff. It's obviously unprecedented stuff, and he doesn't know.
But I mean, look, I'm just asking questions. Look, I mean, come on.
Right.
We know what he really wants when I'm just asking.
I'm just asking
all this.
Yeah, yeah, that's fair. That's a good point. Yeah, I appreciate you bringing that. Oh, so I'm curious, do you view what's going on now with these stimulus packages? How do you view them in a different light versus '08? Do you think they're both?
For sure.
Okay, so walk me through that.
So the big thing. So okay, there's. Let's start with three big differences from '08. The first difference between now and 2008, there is no moral hazard right now. So in 2008, the blow up in the credit markets, the disruption of household credit flows, the mortgage market, all that stuff, extreme leverage at banks that had nothing to do with mortgages, massive gross capital flows around the world, all of that was totally avoidable ex ante from a risk management sense. Right? Like private actors took risks that they couldn't afford to take and then were asking to be made whole.
Right.
And, granted, you still want to make some of those actors whole. And it's not to say that if there's any moral hazard, you can't act to quote unquote bail out. I hate the term bailout because it's overused, but bail out those investors. But there is this trade-off, right? Where they made the wrong choice and they took a risk they shouldn't have taken. And then now they're asking for help. That is not under any circumstance what applies now for any company, for any household, for any bank, for any government anywhere in, municipal government or state level government.
Right.
It does not apply. There is no model for our economy where you can have a modern industrialized economy with the output and the complexity of value chains that ours has, and also have that economy be robust to everyone staying home for 6 weeks to avoid, catching a deadly virus. Right. Those two things are mutually exclusive.
Right.
So if that's the case, and, I think it's pretty hard to argue against that case. If that's the case, then the moral hazard question is gone. So, American Airlines is not at risk of going bankrupt because they bought back some stock over the last 5 years. They would have been almost guaranteed to go bankrupt no matter what. And the question is, do we want that bankruptcy to take place and sort of try to go through that process? Or do we want to ease keep them as a going concern, keep them operating in basically the same sense and give them a grant instead? Now, obviously I'll be the first one to caveat that and say, well, that doesn't necessarily mean that, everyone should, every entity, whether it's an airline or a small business or a household, should all get fully made whole and, yada, yada, yada. There's no wrong actions you can take. But my view is that, there's nothing, because there's nothing that you could expect the private, individual entities to do to forecast this coming. There's no reasonable thing you can say, well, they should get less because they should have seen this coming.
Right. Well, while we're talking about the airlines, I do want to ask you one question. I totally get what you're saying, but is it reasonable to say that these firms, these airlines, that while at the same time they were buying back their own shares, which is a totally reasonable thing to do. I think people say that's a, it's a bad thing. It's like, no, that's how you return money to shareholders, and these go to pension funds. They do all this stuff. It's going back to you if you have a 401k.
It's the same as a dividend. It's just a different tax
treatment. Right. I
mean, it's more flexible too, but that's it. Yeah.
At the same time they were buying back their own shares, they were raising a lot of debt. So that to me is, there's
no world where you, like, the way the modern airline industry works in terms of the margins it works at and the fixed cost base it has, where
right.
it's, you can have a 95% decline in travelers and your capital structure isn't blown up. Like, there's just no way to
right.
make that work. It's too capital intensive,
right.
which is sort of the point. Like, airlines are a relatively special case in this instance where, honestly, it's the same as a neighborhood restaurant, right? If a neighborhood restaurant is operating on 5% EBIT margins, which is a pretty decent margin for a small business, like a small restaurant, if you look at the stats, it's not that good.
Right.
If you're operating on something like a 5% EBIT margin and your revenues go down 90% in 2 weeks, like, you're screwed. There's nothing you can do. And the reason for that is the competitive dynamics in the industry that you're operating in. It's got nothing to do with, like, individual choices of individual companies. American Airlines had a slightly riskier balance sheet, all things considered, or an absolutely riskier balance sheet than Delta did, but right. Delta's just as screwed as American. Right. Like, so, and that's a function of the fact that they're high fixed cost businesses operating in a very competitive environment, going into a shock that they cannot reasonably be expected to prepare.
Right. So your thesis then would be, if they went through, so I don't know if you saw Chamath Palihapitiya's interview on CNBC about, he was basically saying, okay, when he said, are you saying, the guy asked him, I forget his name, are you saying we should let these companies, we should let these businesses fail? And he said, yes.
Scott Wapner, yeah.
Yeah, that guy. Okay. And then he goes on to say that the people that are going to lose money here, the people that aren't going to be able to go to the Hamptons for the summer, it's the people that took on this risk.
Nonsense.
Yeah. Okay.
That's nonsense.
Okay. So you think that's not? So
here's the reason that's not true. And here's the thing that we can explicitly say, like,
yes.
The political economy of bailing out the airlines was not something for people in the Hamptons.
Right.
The biggest proponents of getting cash to the airlines with very little conditions were unions, were the airlines' employees. Right. Because if you put them through a bankruptcy process, if you put the airlines in en masse, which is what would have happened if there hadn't been a backstop both from the Fed and from the federal government. If you had done that, then there's no way that the airline industry doesn't come out of that with a vastly lower headcount and less capacity as it rationalizes, either through mergers and acquisitions or through just the company gets liquidated entirely, right? Debt holders absolutely would take a bigger hit on a relative basis than unions would. I think, maybe not per capita, but certainly in aggregate, I think it's reasonable to assume. But, those unions have pension obligations they need to think about years into the future. They have, their current headcount to think about. They have their pay rate to think about. And all of that would be at risk in a bankruptcy proceeding in a way that it's not as a going concern. And so, the political economy of, it's just bailing out people who live in the Hamptons. That's completely not true.
Right.
Now, granted, like, I think there's a really good case to be made for trying to thread the needle where you're not being too friendly to debt holders, and you're not being too punitive to airline management, and you're not also, just giving out cash with no terms at all. I think that's a totally reasonable conversation to have. But the let them fail attitude is liquidationism. Right. That is saying, like, we want to burn it all down, and that's a better outcome than keeping these operating frameworks in place so that when demand does return, as it will, like, people are going to start flying again, and maybe it's going to take a year or two, but people start flying again. Those airlines can meet that demand, and we don't blow up the whole economy.
Right. Damn, you're really putting me at ease, brother. I like what you're saying here. I don't want to just focus on the airlines completely, but I do have one more question. What about the people that say that, okay, rather than give the money to the airlines to then keep their employees on payroll, why not just give the money to the employees directly, and then let if a lot of this stimulus, for example, wasn't going to big businesses, let's just say it was unemployment was, and I'm not saying we should do this, but unemployment benefits were beefed up, and anyone that loses a job will be made whole directly, versus giving it to the companies that then give it to the employees. What would you say to that?
Yeah, and so we're already doing some of that, right? Like the PPP money, the
Right.
purchasing Paycheck Protection Program money is basically facilitating keeping employees on payroll instead of giving the employees themselves cash. Whereas the extra $600 a week in unemployment benefits is giving fired employees cash directly, right? So
Right.
we're already doing both explicitly
Right.
in the CARES Act, which is the biggest single relief package that's been offered so far by the federal government. So I think the problem with the attitude of, oh, well, let's take care of the employees via unemployment insurance or whatever, like you're still essentially risking thousands of people getting put out onto the street, having to change careers in the middle of their working lives, having their pension obligations that are a current value, right, put at risk. You're not,
Right.
unless you're willing to make those whole as well in some way.
Right.
There's ripple effect, there is going to be ripple effects in terms of the people that hold the debt or whatever. It's just much cleaner to keep everything on ice as best you can and keep it going. And I'm totally sympathetic. Now I think the more interesting question is, why don't we just nationalize or take large equity stakes in these companies? And again, that comes back to the political economy question, right? Because that if the government came in and took large equity stakes in these companies, that protects bondholders, that protects employees, that protects everyone except airline management. And the way corporate structure works in the U.S., you can't. It's there are some exceptions in terms of the government-sponsored entities back from 2008, 2009, and to a degree as well, large banks. But basically, it's hard to just come in and say, okay, you have to take money from us, right? Like you have to get airline management on board with that. And so then you're, again, creating conflict and delay in a time when the entire economy is melting down, when the
Right.
entire demand for a given industry is melting down. So yes, there are costs in terms of distribution and in terms of equity and in terms of level playing field concerns, whatever, like to quote unquote bailing out these companies, whether it's airlines, whether it's the automakers in 2008, whether it's banks in 2008, whatever. There are totally trade-offs there, but there are also trade-offs the other way, right? If you delay, if you try and drive a hard bargain, if you try and nationalize, without consent, like whatever, then you're basically delaying that eventual aid getting into place and what's happening in the meantime, right?
Right.
So I think a lot of these conversations, like I from an equity perspective, like the last thing I want is for working people who are at most at risk, whether it's flight attendants, mechanics, baggage handlers, like those are the people I want to protect the most too. You cannot like convince me that the best way to do that is for their company to declare bankruptcy.
Right.
Like that, I just that just doesn't make sense to me. And the history of social welfare programs in this country in the last 30 or 40 years would suggest that efforts to help them directly instead of trying to keep the whole structure operating is not actually going to be helpful for them. So it's a strictly utilitarian judgment on my part. And I'm sure there are contrary arguments to that. I've had a lot of them on Twitter with people, but that's sort of where I sit on it.
Right. And you mentioned earlier on, you said a lot of these things that the Fed plans on doing. I talked about their balance sheet, which is at $6 trillion. So you said a lot of these things they said they're going to do, they haven't rolled out yet. So what explains right now their explosion in the balance sheet then? Because it's gone up.
So far year to date, the Fed's balance sheet has expanded by roughly 55%. So give or take $2 trillion. It's a bit more than that, but basically 85% of that is just expanded purchases of treasuries and mortgage-backed securities. So it's very easy for the New York Fed to just go out and say, okay, 50, like quote me 50 billion in like just the treasury market. They could just go out and ask for dealers to show them bonds, and they're going to get good. They're going to get good offers. So that basically when things were going crazy in March, they just went out and started buying in the tens of billions every day. Just give me treasuries, give me mortgage-backed securities. The mortgage-backed securities have a longer settlement cycle, but the treasuries settle within 2 days. So if the Fed buys, settle T+1. So if the Fed buys treasuries on Monday, there are new reserves in the system on Tuesday. It's very fast and flexible and easy for the Fed to expand its balance sheet, provide reserves that are in demand, provide deposits to the private sector. Again, that this is asset swap of QE. So they're taking the bonds off the private sector's balance sheet and they're replacing them with deposits. The deposits are a liability of banks, and that liability is the reserves that are the liability of the Fed. That liability's corresponding asset is the reserves that are the liability of the Fed. So it's just this asset swap, right? Private sector gets more deposits because they're freaking out. Oh, we need cash, we need cash, we need cash.
Right.
Here's some cash. So that's what the Fed's done so far. What I anticipate them doing is slowing Treasury and mortgage-backed security purchases quite dramatically. They've already done that so far, but I said on Friday, like, they really don't even need to be doing any Treasury purchases at all once these large credit easing programs get in place. And the reason for that is that there's already a lot of reserves in the system relative to demand for reserves, which isn't necessarily a bad thing. It's just, there's no urgent need for liquidity in terms of new reserves being added to the system. So that's good. That's one thing ticked off. They're also going to be adding more reserves by buying these corporate bonds. Like that's what is going to be happening mechanically. They're going to be adding reserves to the system. And so there's even less need to be purchasing more treasuries and mortgage-backed securities. Basically, the only reason to keep doing it is, in my view, is to signal to the market that they intend to be very easy for a very long time to come. And so I think that's what we'll see. We'll see this shift away from relatively standard tools that we're all very familiar with: buying treasuries, buying mortgage-backed securities, extending repo. Foreign central bank liquidity swaps are in there too. That's sort of a different thing we don't need to get into. And then, switching that to, okay, instead of coming from that, all the balance sheet growth is going to come from these credit programs.
What would you? At what point would you draw the line? Like the Bank of Japan has purchased equities. So would you say that if the Fed started purchasing equities, that you would say, okay, this is probably over the line, or do you even have a line?
I don't know why there's a line. Why is there a line?
Well, I mean, to your point about moral hazard, I mean, if the Fed is starting to purchase large stakes in companies, does the Fed, is that good? I mean, for the people that own these equities, is the Fed
purchasing large stakes in companies, or are they purchasing ETFs? Because those are two different things. BOJ is only buying ETFs; they're not buying whole.
Well, they're not buying individual companies, but those ETFs are made up of individual companies. No.
Sure.
So,
sure.
Well,
the thing is, though, like, I guess my point is that the Fed is not buying a stake in a company in the sense of control over that company in a meaningful way, right? I mean, I know it's sort of technicality, but when you say buying a stake, that's sort of the
totally. It's different. It's absolutely different. Yeah.
So.
Okay. So, okay. Then another question here, and then we'll move on to something else here, though. Is so after 08, 09, I think and correct me if I'm wrong here, but the Fed balance sheet was at about $2 trillion, and it just started to decrease. And then this happened, and then it exploded. So I'm curious. So it's at about $6 trillion now. Where do you see? Let's say in 5 years. Let's say in a year, a vaccine comes out and things start to go back. Things are going back to normal, and the optimist case works out. Where do you see the future of how the Fed gets this stuff off their balance sheet? Is that going to be a bumpy ride, or is that something that people should be worried about?
I don't know why you would be worried about it. I mean, so the Fed proved that they're perfectly capable of running off assets via maturation when it comes to treasuries and mortgage-backed securities. Like, we know that works. We know that they were able to do that, and it didn't cause any massive problems.
Right.
They halted that process. They didn't get that process probably as far along as some people wanted them to, but they got it to the point where there was a scarcity of reserves, and that scarcity of reserves is what gave us the repo mess last September. It feels like, right. Decades ago now.
Right,
but,
right.
They were able to wind down their balance sheet to the point where there was scarcity of reserves, and they had to begin providing reserves again. So to me, I don't see any reason to be concerned about them rolling off their balance sheet when it comes to these corporate lending programs, municipal lending programs. Like, they have, explicit end dates for those when repayment is necessary.
Right.
And as for the rest of the portfolio, which is, again, treasuries and mortgage-backed securities, we know they can wind those down, in orderly ways. And so if there's a need to, and if they choose to. So I don't see any particular reason to be concerned myself.
Got it. Damn, I need to. Yeah, you're putting me at ease right now, brother, because I don't like getting people fired up, and I don't like thinking these things that I think being worried about this stuff. And you know a hell of a lot more than I do. So I'm curious. Then, what are you worried about? Anything? Like, obviously you're worried about what keeps you up at night right now then?
Yeah, well, like the virus and the economy and the interactions
Right.
therein. I mean, we basically, so, talking to people around the country as states are starting to reopen, like people aren't being cautious enough, right? We're going to see a re-acceleration in case counts, and that doesn't mean we're going to see a repeat of what happened in New York, which is the worst case for the American system. I think pretty maybe, there have been a few rural areas like Southeast Georgia that have been similarly hard hit, but basically the mass casualty event of New York's COVID infection is definitely the worst case scenario, and we're not going to see that again. But thousands and thousands of new cases a day. We're gonna scream past 100,000 deaths from COVID in this country, and that's going to keep rising over time. And that all is going to have an impact on how dramatically consumers retrench in terms of their spending, how businesses think about investment based on consumers' decisions. We've seen a huge amount of fiscal and monetary stimulus so far this year. By far the biggest stimulus for any year on record relative to the size of the economy. But we've also had the biggest shock for any year on record relative to the size of the
Right.
economy. So to me, when I'm seeing dozens and dozens of different companies come out and saying, yeah, CapEx is going to be 20% lower than we thought it was going to be. And when the savings rate is at a record level in March, dating back 30 plus years to 1984, I think was the last time it was as high as it currently is. Um, you know, when I see consumer sentiment unwinding 5+ years of gains in 6 weeks, when you've got 14% unemployment and substantially more joblessness widespread, you know, the degree and the length of fiscal stimulus that we've got is not going to be adequate, I don't think, to offset the amount of demand shock that has taken place, the amount of the shock to incomes, and therefore consumer spending and confidence of households. And so my worry is that we see, a substantial in percentage terms, but in terms of retracement, relatively modest bounce in activity in May relative to April, which will be the low. April will be the lowest activity month. I worry about seeing a modest bounce in May and then basically back to lockdown in June or July as case counts fly because everyone's not worried anymore. And just the idea that, well, that's going to mean we need more fiscal stimulus, with Washington sounding like they don't want to do a lot more fiscal stimulus. I'm dubious. It's dubious to me that even under rosy scenarios for the outlook for the virus, that the existing stimulus on the fiscal side is going to be enough to restart the virtuous cycles of demand and supply that are a normal part of a growing economy. And if the market is expecting to get back to trend growth in EPS in 2021 or 2022, it's going to be sorely disappointed under a relatively negative economic scenario. And so, stocks are overvalued here. I think credit is attractive, and I think stocks are overvalued. And I'm very much not alone in that feeling. It feels like everyone I talk to feels almost identically with respect to the equity market. So it's against my own biases to take a consensus position, but that's sort of where I'm at with it. Just because I really think that the economic shock is going to be ongoing, and the bounce back is going to be so much less than people expect it to be.
Right on. Okay, I appreciate that rundown. And specifically, you've talked about you've touched on this a little bit, the municipalities and states, and you're urging, it looks like on Twitter, and correct me if I'm wrong, to give them grants. And I know Mitch McConnell has made some statements about being weary of bailing, for lack of a better word, bailing out states and municipal governments. He's been a little bit not too on board with that. I'm curious, what do you think the federal government needs to be doing to be supporting the states and cities right now?
The simplest thing to do would just be to say, we will give you the difference between whatever your tax revenue run rate currently is and what it was in 2019. Something to that effect. Just, we're going to underwrite any budget shortfall you have for 2020 so far based on this shock from COVID. Or you could do 80% of the shortfall. It's not hard to compare run rates for year-to-date collections and, compare those to where they were last year and say, okay, we're short this amount, because that's what states are already doing. And instead of responding to that by issuing debt or by, asking the federal government for money, they're doing what they're supposed to do in terms of the laws and constitutions at the state level that govern their activity, which is fire workers, right? They're cutting back operating expenses because they've got lower operating incomes. And that's nuts. There's no reason they need to be doing that. The federal government could be preventing that from happening. And I think that's what it should be doing. By the exact same logic that we don't want, American Airlines to go out and fire 20% of its workforce just because it's unable to roll its nearest maturity debt over, or, whatever logic you want on the corporate side. Like, we want the restaurant down the street that's had to furlough all of its workers to stay open, so that when demand returns and then the lockdown's over, it can just open its doors and immediately bring back its workers, instead of having those workers have to go to find other employment in other businesses, right? We're trying to remove these frictions, right, out of the marketplace, out of the labor market, out of the productive markets of this country. And so that applies to state and local governments too. And there's no reason that we should have state and local governments firing. It may work out to millions of people, over the next couple of years, because of shortfalls in revenue that the federal government could have easily offset with no consequences with respect to moral hazard.
Got it. And it sounds like you're gung ho on the stimulus and what the Fed's doing. You think this is a big Fukin deal that requires the Fed to just unload to keep things from getting worse and having a bad, unfortunate cycle of cascading effects. I'm curious, what do you think about the deficit we're going to run this year, and then also just the debt in general? Now, I want to preface this by saying, and we've talked about this on the show, that I think people look at, the debt's 25 trillion. They say, oh, that's huge. We're never paid off. And it's like, of course, we're never going to pay it off. But as long as we can service the debt, and that's a small percent of GDP, then we're okay. If it's I think our interest payments are, 1% or something like that of GDP, something very low, which is fine. As long as they don't blow up to 20%, then we're okay. Do you have any thoughts on, in 2025 when we got to start thinking about this, and we got to start?
No, we don't. Look, the only constraint on a sovereign borrower that issues in its own currency, the only constraint, the only binding constraint is inflation. If inflation's low, nothing else matters. Everything else is literally just questions of organization. It's the color of the book you write down the numbers in. That's it.
Right on.
And I'm sure that's going to sound crazy and controversial,
right?
And, whatever. But this has been borne out absolutely true for every sovereign issuer, whether it's gilts, whether it's yen, the Chinese government, the US government, the Canadian government, the Australian government, the Kiwi government, any developed market sovereign currency borrower that has monetary sovereignty, if they have that, then that's it. Inflation is your constraint. And we just there is no evidence of high inflation in this country whatsoever. There's none. There's no evidence that there's a substantial mismatch between supply and demand in aggregate terms. And there hasn't been in many years. And so if that's true, then there is no concern over the rate of inflation, the level of government debt or the issuance of government debt. If inflation starts to surge because we've directed too many real assets towards, if we're using government deficits to direct to direct real resources towards ends that are exceeding the economy's aggregate capacity, that creates inflation. Then, so the example would be as if, we decided tomorrow that we're just going to deficit finance a colony of 100 million people on Mars, right? Like enormously expensive in terms of not just like the dollar value, but like the real resources required to move 100 million people to Mars, right? There's no way we could afford to do that, right? So that would create massive inflation because the government would be going out and competing for goods and services that other people want to buy, and that would create inflation. And that would be a real constraint on both the level and the amount, the deficit the federal government, the level of the federal government's debt and its annual deficits. But that's just not the situation we're in.
Right.
The vast majority of federal government expenditures are transfer payments of one kind or another. Very little of it is actual deployment of goods actual deployment of real resources towards goods and services that competes with the private sector. And so, when that's the case, it's just very hard to create conditions where the deficit sparks enough demand that you're running up against capacity constraints that lead to inflation.
Would you consider yourself on board with then modern monetary theory?
Yeah, I just gave you the MMT highlight.
Yeah. Okay. So I'm curious. I guess I guess I keep asking questions because I'm trying to find at what point. Well, you've said specific things where as long as it's not competing with private goods and services and stuff like that. I'm curious then, and I want to ask get into politics a little bit here. Do you think AOC, Alexandria Ocasio-Cortez, do you think some of the things she says about some of her proponent or the things she's putting forward with how the government should spend money, taxes aside, but just that we can spend this money and we can raise our deficit can be a lot bigger and we'll be okay, and we're not going to see some knock-on effects of that. Are you worried about that at all? Or are you kind of on board with how she views that specific part of her kind of, I guess, outlook on how this all works?
I will say Alexandria Ocasio-Cortez is absolutely correct that if inflation is low, then there's no reason not to run large deficits and improve the lives of people around the country. I mean, that is absolutely the case. Now, how long will inflation remain low? I don't know. I mean, maybe it'll start rising for structural reasons or something. I don't know. But there's no reason, as we currently see, based on what we see in front of us and based on what we've seen in recent history, to assume that inflation is about to surge. Right. There's no reason to assume that.
What about Trump's tax cuts? What do you mean about them? They added a lot. They're adding to the deficit, and the economy was running. It doesn't matter.
It doesn't matter because so here's the reason. So they were the Trump tax cuts were very, very unfortunate from a distributional perspective because they gave the most benefit to people who needed it the least in terms of their income levels.
Right.
So I'm not making a general defense of the Trump tax cuts as good policy or something.
Sure.
But in terms of sparking inflation, meaningless, completely meaningless. And the reason is what I just said, the distributional effects, right? If you give somebody who's already making an income of $500,000, $600,000 a year, an extra $15,000, $30,000, $45,000, very little of that is going to get spent on real goods and services, right? Very little of it. Most of it's going to get saved. And that's generally true across economies and across time, that people with lower incomes tend to spend a higher percentage of every additional dollar of income they earn than people with high incomes. I mean, that's just a Maslow's hierarchy of needs thing. Once you get into the upper middle classes, you just see marginal propensity to consume fall off a cliff. If we go out and give everybody in the country $1,200, as we've just done as part of a stimulus effort, under the $75,000 a year income, that's going to be a lot more useful than if we give the same amount of aggregate money, but give it equally to everybody in the country. And the reason is that the higher end money that's given out is not going to get spent in aggregate because those consumers tend not to spend, especially when they're uncertain. Whereas lower income consumers tend to spend every dollar that you give them, and sometimes more than what you give them. If you give some strata of consumers $100, they'll borrow money on top of that, right? Because of confidence, there's a bunch of reasons for it. But basically, there's an extremely high spending power there. So that form of stimulus of aggregate demand is very, very powerful. Giving money to people that don't make a lot of money is a very powerful form of aggregate demand stimulus. It's not when it's the other way around. And so that was the issue with the Trump tax cuts, is that, they were coming at a time when the economy was doing well and we didn't need stimulus, and they did expand the deficit, which should be stimulative at the margin. And it was stimulative at the margin. It was more stimulative than it would have been if it hadn't taken place. But in terms of the degree to which they were stimulative relative to what they could have been, it was nothing, and because of the distributional consequences.
Right. Where do you stand on UBI?
So as someone that's involved in MMT thinking and sort of uses that as a basic framework, I tend to lean more towards a job guarantee as a more preferable policy to UBI. And there are a few reasons for that, but in general, I mean, I think um, the most important thing with a job guarantee relative to UBI is that a job guarantee would involve creating something as well as just a transfer of income. So basically, if you have people going out and performing social work or building infrastructure or creating art or any of a range of things in a job guarantee framework, you are increasing the productive capacity of the economy at the margin. Whereas if you're doing UBI and you're spending the same amount in terms of the outlay, of income to people that need the income, or everybody on average getting the same amount, then you're transferring income around without expanding productive capacity. And so to me, a job guarantee is preferable, with the obvious caveat that a job guarantee isn't a universal program or a job guarantee isn't a program that can fill in for other critical parts of the social safety net.
I'm curious. So would this be like a federal job guarantee, or
Yeah.
got it? Are there any worries that they'd be competing for people's competing with the private sector for jobs that might be able to put these people to better, more productive uses? Do you have a worry about that?
It depends on the specific
Okay.
level of wages and income you set. Okay, so for instance, if you set $15 minimum wage with the job guarantee and full healthcare benefits, then are you really stealing productive resources from the private sector? How are we? Or do we really think that there's going to be a meaningful crowding out effect of that labor market demand? There's going to be a crowding out, but is it actually going to be of a productive
Right.
variety? Because there's a lot of businesses that rely on artificially suppressing labor market conditions to keep operating the way they do, right? So the other thing I would say is, and I wrote a column about this recently, we already have a jobs guarantee for a specific subset of people in this country. It's called the U.S. military, right? If you
Right.
want to go out and hump an M1 or whatever, and obviously 10 for every one soldier in the army that actually carries a gun, there are 10 behind them doing logistics stuff. So
Right.
more than likely you're talking about other folks. But if you want to do that, there is an open bid for your labor. And we
Right.
would never in a million years talk about the crowding out effects of
That's
the
an
US
excellent
military as a
point.
job guarantee.
Right.
So yes,
Right.
I'm sure there would be businesses that would struggle to operate paying their workers a living wage with full healthcare benefits like they would be able to get at a job guarantee, for sure. There are also businesses that would exist that currently don't because we have minimum wage laws in this country. And so, it's really just a different point on that same spectrum of trade-offs. And, I think there I haven't heard a convincing argument that setting a reasonable and stable level of minimum compensation under a jobs guarantee is something that would crowd out large swaths of economic activity that is highly productive in a way that we should be concerned about removing.
Right on, right on. Okay, just a couple more things. We went a hell of a lot longer than I thought we would, but dude, honestly, I love talking to you. You're kind of blowing my mind with a lot of this stuff, and I love it. Do you think Biden was the right nominee? I assume
No. No.
well, so let me ask you this. Let me ask you, like of the field, that was there. I'm not saying someone else ran that didn't. Do you think that? Because I'm assuming you probably, and maybe this assumption is wrong. You probably don't want another 4 years of Trump, but maybe you do, and we can talk about that. But if you don't, or even if you do want another 4 years of Trump, do you think Biden has the best shot at beating him? Maybe it's just, I don't know, and I don't want to, you don't have to say something if you don't believe it, but I'm curious.
I think it's there's a lot of focus on in the U.S. political system. There's a lot of focus on the horse race and the individual personalities and that sort of thing.
Right.
And I think this election, more than any other, that stuff just really isn't that important. I mean, Biden would not have been my pick to be the one that represented the Democratic Party in the fall elections, but
right.
It's not my decision, so whatever.
Right.
Right. I think, there is a structural headwind for the president based on the fact that he's in a midterm he's not popular. He had big losses in the House in his midterm elections and
right.
in his first term. He's got a shrinking Senate majority. His party is losing ground in state houses around the country. This all sounds a lot like other presidents that have done poorly in their reelection bid. He's basically it's pretty unprecedented for a president to be as unpopular as he is and to win reelection. It's possible, but it's not particularly likely. If you look at the polling at the state level nationally, if you look at betting markets for like who betting markets think will win individual states, it all says the same thing, right? The by far the most likely outcome is a Democratic victory in November. Now, it doesn't mean like that means there's no chance that he could win again,
sure.
or that there's no point in even having an election or something like that. But the consensus is that he's gonna repeat what happened in 2016. And it's really important for people to remember that what happened in 2016 was, statistically speaking, was an outlier event, right? It was not something where...
Well, he had about a 20% chance, right?
Ex ante, who knows what the chances are, but I think the way I like to phrase it is he won by 100,000 votes in 3 states. And by any margin, that is not a convincing victory. That is not some massive victory. Right. And that's not to say that it wasn't legitimate or something like that. I don't necessarily subscribe to that view, but I just think people's mental framework is, he won in the electoral college, so he won this huge victory, and so he's just going to do that again. And it's like, well, yeah, but he barely won it by any margin of vote at all, and he won in conditions that were the opposite of this year. 2016, very, very unimpressed electorates on both sides, with the exception of like Trump's core loyalists, but it was a low turnout election. 2018, the midterm set multi-decade records going back to 1960.
Oh shit! Okay.
For turnout, right? Massive turnout in midterm elections, right? And so we've had this complete inversion from massive voter apathy to massive voter enthusiasm. Voting, with the same guy on the ticket, like you don't have to be a rocket scientist to say, hold on a second, this is maybe not. I shouldn't be anchoring to the same scenario we just saw.
Right.
Trump could totally win. I'm not out here saying he has no shot at winning. Maybe 40%, 30%, something like that. Like he's got a 1 in 3 chance. I don't know at where things stand right now. But by far the most likely outcome, in my opinion, if you 1 in 3 chance for Trump to win means 2 in 3 chance for Biden to win.
Right.
That is what I see happening, and a lot can change between now and November. So who knows? But that's sort of how I've seen this whole dynamic, and I am not convinced that the Democrats' choice mattered at all. Whether it was Sanders, Warren, Harris, Booker, I don't think it would have made a big difference. I really don't. And I'm not sure if that's necessarily an endorsement or an indictment of any of the personalities or the party, but I think it's just the way things are this year.
God, dude, there's so many things you're touching on. I just want to ask you. God, I keep saying only 2 more questions, but I can
do another 5 minutes. I'll cut you off after 5 minutes. How about that?
Well, dude, I want to be mindful of your time, Brother Beast.
No, we're good. No, it's totally fine.
As long as you chill. I do have. Okay, so what you I am curious because I like asking you things about things I've said on this show, and then you've basically just said a few things you've said is basically just said the opposite, which I love. I'm just getting pounded right now. I'm curious.
I don't know what you've said for the record.
No. Of course. No, but my viewers know, and I know, and I like learning here, and you're great to talk to. It's blowing my mind right now. So, what would you say? You mentioned, if it was Bernie or if it was Elizabeth Warren. I'm curious. Do you think for take Bernie Sanders, would he worry you at all with some of the policies that he was talking about putting forward, and the cost of some of his policies, specifically of his plan?
Let me just cut you off.
Yeah, go.
Because we've talked about it, right?
Right. It doesn't matter.
As long as inflation's low, it doesn't matter.
Right. It doesn't matter. It doesn't
matter. Whether it's Medicare for all, whether it's free state.
Okay, so we don't need to hash it then. Let me ask you this: what about the notion of employees having board seats?
Yeah, I mean, I think that's a model that's worked well in other parts of the world. It's not a cure-all. It's not something that's like going to fix everything overnight.
Right.
But it's very clearly a model that works well in a number of other countries. And the most cited example of this is Germany, but it's true in other countries as well. And I don't think there's anything particularly radical about it relative to other functioning countries that have a slightly more socially democratic system than we do.
Right. Well, so I'm curious, just a counter to that. Wouldn't it be? Yeah, you mentioned Germany, but Germany isn't in terms of which country has the most valuable companies in the world. It's the United States. So I'm curious if like maybe Germany has some policies that we don't, that maybe we could have, but where does that stand with? I like to just look at kind of the record, right? In terms of businesses, the United States, the S&P 500, we have the best businesses in the world. So, do you think it's right to be modeling some of our stuff off of other countries?
Well, so if your whole goal in society, if your yardstick for society is
Right.
what's the aggregate market cap of your companies,
Yes.
and that's how we're going to measure success, then sure. I personally, and I think almost anybody you ask in this country would say, wait, the only thing we're going to measure success by is how valuable our companies are. I don't think that's right. That doesn't sound right to me. Right. And it's not, there's no way it's right.
Yeah.
Because that implies that you don't care at all for, I don't know, basic access to, fundamental services. It implies you don't care about democracy at all. It implies you don't care about equity at all. Like you don't care about fairness at all. You don't care about racial equality. You don't care about cultural diversity. You don't care about any of this stuff. All you care about is the market cap. Well, so obviously no one's going to think that way.
Right.
Totally point taken that German companies tend to be less valuable in terms of their multiple. They are definitely smaller in size. But I've been doing this long enough to remember the recovery from the crisis, and when the entire world wanted to replicate the German Mittelstand, right, which is the sort of the network of small manufacturers and family-owned companies and SMEs that support, Germany's very robust export market economy, right? And like that was the goal. Like we need to replicate the Mittelstand, and like, here we are now being like, whoa, wait a second, we shouldn't need to be exactly like Germany. Well. Nowhere's a paradise. Germany's not a paradise. France is a paradise. UK is a paradise. I was born and raised in Canada. Definitely not a paradise. Canada confirmed. No paradise there. But that doesn't mean we can't take good ideas about, that might move society in a direction that we want it to go in from other countries. I don't think there's any reason that it has to be an absolute, trade-off like that.
Right.
So, that would be my take on that.
Right. I'm curious. And correct me if I'm wrong here, but you're as a global macro strategist and thinking about being in this investment world, are you in the minority with some of your beliefs? With some of the things
probably, I don't know.
You don't, right? Because it seems like, dude, I thought I was getting a business hardo on here. You're talking about all these things. I'm looking at my notes like, you're talking about MMT, you're talking about printing money, you're talking about job guarantees. I'm like, I'm just like. It just seems, again, correct me if I'm wrong, but it seems like that type of thinking is kind of, and maybe I'm misunderstanding what you do day to day, but it seems, for lack of a better word, antithetical to kind of what, or not antithetical, but it seems like it wouldn't.
Anybody that takes the approach, and this is gonna be my last answer. Unfortunately, I have the commitment to spend some time with my brother. But
no, all good, brother.
I think anybody who takes the approach. Where there needs to be some sort of maximalist extreme ideology to understanding anything complex is going to be sorely disappointed. So, whether that's stock markets, global economics, whatever, if your approach is doctrinaire and fixated on a set of prescribed rules or beliefs that are not grounded in some measure of diversity, you're going to have a very hard time figuring out all the outcomes.
Right.
And I'm not paid to be an ideological proponent of any one thing. I have my beliefs, but really at the end of the day, my job is to figure out what's actually going on, regardless of what I think should be going on.
Right.
And so, in some instances, and sometimes it works against me, but there are definitely a number of instances where having the intellect, a slightly different perspective, socially, politically, economically, whatever, from the sort of median person that does the kind of thing I do, is incredibly useful and gives me a huge leg up, because I have the flexibility to say, well, I don't have to be thinking about condemning this thing. I can just acknowledge it as a thing that's happening and move on and fit it into my model of the world.
Right.
So to answer your question, like, yeah, I'm definitely not a business hardo, but even if that's what I was paid to do, it would be, it wouldn't be helpful of me to have that ideology,
right,
doctrinaire in some way, as opposed to just having the views I have and trying to, use them as best I can to understand what's going on around me, as opposed to dictate what should be going on.
Right. Well, George, I think that's a great thing to end on. I really appreciate you coming on. This was honestly my favorite interview I've ever done on this show. This was fucking epic. You were kind of blowing my mind. I appreciate how fast you were talking and just riffing right through all this stuff. So really appreciate you coming on, brother, and I hope we can talk again at some point.
No problem, man. Let me know if you're ever in Charlotte.
Yeah, for sure. Okay. Adios, brother.
Later.
Okay, everyone. That was George Pearkes, and you can find him on Twitter at Pearkes. That's his last name. That was a lot of fun. Okay, so that went. Damn, we always go fucking longer, but dude, I love talking to that guy. That guy was blowing my mind. There's a lot of fucking things I wanted to ask him. We didn't even get into cryptocurrency stuff. I wanted to ask him about Brexit. Wanted to ask him his benchmark for judging his investments, talking about index investing and shit. We didn't have time. That's all good. That was electric. That guy's a legend.